ICICI Bank's earnings in the second quarter of FY21 have surpassed the street estimates by a huge margin. In our ideas for profit today, we'll discuss what should be investor strategy on this bellwether stock post the Q2 earnings. Let's look at the key highlights first. Now, the domestic loan book has increased to 10% year on year, led by the retail as well as the SME lending, which grew by 13 and 22% year on year respectively. Interestingly, the disbursements of home loans, car loans and the rural lending have also reached the pre-COVID levels in September. Now, however, the disbursements of commercial vehicle loans, personal loans and credit card spends, though have recovered over the previous quarter, are still well below the pre-COVID levels. Now, the deposits growth, however, were quite robust at 20% and was also driven by, say, 26% growth in the term deposits. Now, the growth in CASA, that's also deposits, these were also healthy at about 12% year on year. Now, net interest margin or NIM on the domestic book for the quarter, however, dipped marginally to 3.5%. Now, bank's liquidity coverage ratio stood at 150% at September end. That is higher than the previous quarters. Now, though the fee income declined by 9.7% year on year, it actually grew by about 49% sequentially. Operating expenses declined by 5% in Q2, and consequently, the cost to income ratio improved by 470 basis points year on year to 39.2%. Now, the gross slippages to NPA increased in Q2, but also due to higher write-offs, the gross NPA ratio trended downward to 5.17%. Loans amounting to over 1400 crore rupees were not classified as GNPA, and that is pursuant to the Supreme Court's order dated 3rd September. Now, provision coverage ratio improved further to 81.5%. Moreover, the additional provisions of 2.26% of loans is much better than the peers also. Now, in the current crisis, the bank has acted quite quickly to protect its balance sheet, which was painstakingly cleaned and made much stronger in the past decade. Now, the bank also took two key steps to protect the balance sheet strength in the current challenging times as well. It also built reasonably good amount of contingent provisions and raised equity capital to meet any kind of future exigencies. Now, the management is quite confident that the provisions, which includes the COVID-19 related provisions as well, amounting to, say, 14,731 crore rupees, equivalent to 2.26% of its loan book, that has created an addition to the provisions coverage ratio of over 80%. And this will completely cushion its balance sheet from any kind of potential credit losses which may arise due to the pandemic. Now, the bank is more than adequately capitalized and well poised to capture the growth opportunities in post-lockdown period as well going forward from here. Having achieved the balance sheet strength, which is paramount for any bank, ICICI Bank is also likely to see strong earnings growth in the coming years. Now, thanks to its superior funding profile, ICICI Bank's cost of deposits has been among the lowest, that is 4.22% in Q2 FY21. This, coupled with the increased share of high-yielding retail loans, which now constitute about 66% of the total loan book, that has boosted ICICI Bank's net interest margins or NIM on its domestic book to 3.8% to 4%, which is comparable to the best. The strong NIMs, along with stable fee income and better operating efficiency, which will help bank deliver core pre-provision operating profit growth of more than 15% over the next 2 to 3 years. However, the gross NPAs are expected to rise for the banking industry, including for ICICI Bank in the second half of the current fiscal year. But since ICICI Bank has sufficient COVID-19 related provisions which it can utilize in the coming period, we may not see an accelerated provisioning or hit to its profit. Going forward, the bank can easily generate return on equity of 15%. Now, with the stock currently trading at around 1.3 times FY22 estimated core book, the current valuations definitely offer high margin of safety and a favorable risk reward play as well. Now, investors should actually look at the bank's valuation, which is extremely attractive, offering a room for substantial re-rating also going forward from here.